Imagine, if you will, a gathering of some of the world's most astute investors, united by a common thread in their investment approach. An approach that traces its roots back to the legendary turtle trading experiment of the 1980s. Picture a scenario where these minds, steeped in the discipline and strategies of this iconic experiment, converge in one place. Well, imagine no more, for tonight the vision becomes a reality. We find ourselves in Sydney, the vibrant heart of Australia's financial world. Here, we're not just attendees at an event, we're part of a historical journey, revisiting and reviving the principles of the turtle traders. Our journey takes us back to an audacious venture by Richard Dennis and Bill Eckhart, two pioneering Chicago pit traders. Their experiment, a blend of mentorship, discipline, and systematic trading, wasn't just a financial venture, it was an exploration into the potential of the human spirit in the world of finance. This evening, we are graced by the presence of Michael Covel, the celebrated author of The Complete Turtle Trader, ready to unveil the intricate layers of this fascinating story. Joining him is Jerry Parker, an original turtle trader, bringing his first-hand experiences and insights from the front lines of this financial odyssey. Complementing them are the new generation turtles, Moritz Seibert and Moritz Heiden from Tarkahe Capital, based in Germany, along with Australia's own Adam Havryliv from East Coast Capital Management, each demonstrating how the turtle principles continue to shape modern-day trading strategies. Tonight is not just a nod to history, it's an enlightening exploration for the Australian investor into the power of the turtle trading method. This approach has shown remarkable resilience and success, adapting and thriving across varying market conditions. Our event tonight is made possible by the generous support of our sponsors. Australian Fund Monitors brings their deep understanding of the hedge fund sector. Australian Patent and Trademark Services, led by the renowned Alex Ferrante, ensures the protection of our intellectual property. And Assist Me, who transform our operational efficiency, allowing us to focus on our strategic objectives. Welcome to the Aussie Turtles event at Bebo Wine Bar, where we celebrate the rich legacy and ongoing relevance of the turtle trading experiment. Let us embark together on this enlightening journey into the world of classic trend following.
What is this Aussie Turtles about? And the Aussie Turtles is effectively paying a nod to the famous turtle trader experiment of the 1980s, which is quite well known internationally, but in the Australian circles, it's not so well known. So tonight, that story changes. So we've got a number of very eminent speakers drawn from across the world who've come here tonight to tell you about the turtle story and the amazing experiment that was hatched in the 1980s. We've got Mike Covel, who is on screen. So he's from in Saigon at the moment. So Mike, welcome aboard. Thank you for being here. And please tell us about the turtle story from your perspective.
Well, from my perspective, it changed my life, and I wasn't even a turtle. I'm the only person, I suspect, that knew the name Jerry Parker, except Jerry Parker in 1994. I knew Jerry's name in 1994. I doubt anybody else there today knew Jerry's name. And for me, it was fascinating because here I was in my mid-20s or so, and I wanted to work on Wall Street. And I had just been to World Trade Center 7. I had seen Salomon Brothers' famous trading floor as profiled in Liar's Poker. And I'm thinking, okay, they're not going to hire me. And randomly, I walked into the Borders Bookshop in Tyson's Corner, Virginia, and I saw 1993's Top 100 Paid on Wall Street. And I'm like, oh, this is really interesting. Who are all these 100 people that just made all this money for the year? Number 25 was R. Jerry Parker Jr., Chesapeake Capital. And damn, that guy lived 90 minutes from my house. He lived like a half hour or less away from where I went to school my first year in college. And this article was really short. It said something about growing traders like they grow turtles in Singapore. And this guy, Jerry, he was he liked country music and he was in the Virginia boondocks. And okay, I grew up in Virginia. I knew something about the Virginia boondocks. And so I was like, wow, I've got to meet this guy. Who is this guy? Because in this little brief article, it was talking about how he was doing a trend tracking system. And he didn't need to be on Wall Street and didn't need to know the fundamentals. And at that moment, I thought to myself, how much of modern life is a lie? Like, because if he didn't need to know that information, then why did I need to know about Warren Buffett? Why did I need to know the fundamentals? Why did I need to be able to read a balance sheet? Why was that important? Now, of course, I didn't know at the moment the answers to these questions. I just knew that this guy, Jerry Parker, knew the answers. And I had to meet this guy. So I'm 90 minutes away. Now, look, this is 1994. AOL email is just getting started, right? There's no GPS. There's no maps on your phone. There's no iPhones. So I had to go to AAA and get something called a triptych. And I had to get this paper map. And I'm driving through the countryside area surrounding Richmond, Virginia. And I'm like, where in the hell is this guy's office? Because I just got to see this guy's office. He's in the middle of nowhere. And I'm like, I can't find it. So I pull over to like some local bank and I walk in. I'm like, do you guys know where Chesapeake Capital is? And the teller looks at me like, what are you talking about? And then another lady's like, oh, I think it's across the street. And I'm like, I drive over across the street. There's a gravel parking lot, a bunch of cars, a modest looking office that looked like a bunch of CPAs or attorneys worked there. And I'm thinking to myself, and I see the sign, Chesapeake Capital. And I'm like, what in the hell is going on? I was just at Salomon Brothers office at World Trade Center 7, and now I'm here. This doesn't make sense. What is this guy doing? Well, he didn't agree to meet with me that day. And it took 18 more months of bugging him before he agreed to meet with me. But he did agree to meet with me. And that meeting started me down the path of eventually writing this Turtle Trader book a decade later. And I got to tell you, everyone today can read that book and everybody can understand the details. I might ask Jerry about this a little bit later, but it was quite a secret thing. This was not something where, you just kind of knew what was going on. I mean, there were walls upon walls upon walls. And even for the peers that many people in the room today know about, like the Dunn Capitals and the Ed Sekotas and the Larry Heights, I mean, this was all kind of pre-internet. So there wasn't, Jack Schwager had his book, and that was mysterious too, because anyone that read the chapter about the Turtles and Rich Dennis and Bill Eckhart in the Market Wizards books, those were mysterious. So this whole thing was mysterious. And I think for me, to bring it back to something was the data. That when I started to see the performance data of the Turtles, that started to tell me a story. I started to kind of like piece this together. Because I got to tell you again, and not Jerry, because Jerry was very humble and Jerry agreed to meet with me. Actually, I think I met with Jerry a couple times early on. But there were many of Jerry's peers that were not happy with me. They were not happy that I wanted to share this story. They were not happy that I was digging. They were not happy at all. And there were multiple lawsuits came my way. I mean, I'm not joking about like, okay, Mike's just saying they threatened a lawsuit. Nope, there were filed lawsuits that came my way. And it was more. That was also another lesson. It was like, wow, why are people trying to keep this quiet? So it was so interesting for me as I had these early experiences meeting this humble guy down in Mannequin Sabbath, Virginia, and then I start to like poke around and other people were like, throwing the uppercuts at me. And I was like, wow, what is going on here? It's the most interesting story. And so that ultimately led to desiring to write the book in the mid 2000s, around 2000, after my first book. And I got to tell you, about half the Turtles agreed to talk to me and the other half threatened lawsuits. Again, not Jerry. Full disclaimer, Jerry was always super nice. But it was a wild ride, and it was so fun to piece together. And look, I had no investigative journalism training or anything, but it was an investigative journalism project. And look, it was fascinating. And I'm sure, look, everyone there today is there because you're fascinated. And for me, ultimately, the story is right back to what I said earlier, which is it kind of proved that so much of Wall Street is a big lie. And it also proved, which is another reason why everyone's there, is that these rules could be taught. It did not mean that everybody was going to be successful. We know Jerry hit the home run. Some other turtles didn't hit the home run. So, but still, if you knew that there could be a Jerry Parker, the inspiration was, well, damn it, if that guy Parker can do it, maybe I can do it. Maybe I can figure it out. And I think that's why the story is so enduring today, is that everyone hears it and they're just like, wow. You mean I don't have to be born with a silver spoon? I don't have to be connected to Wall Street. I don't have to be this. I don't have to be that. All I need is a little capital, some rules, learning some discipline, and stick with it. And damn it, I might get a chance to get some of that Jerry Parker success. Hey, that's the story, and it's an amazing story, and it never gets old. And I'm sure even for Jerry, I know he pinches himself and says, "What the hell? How did I find my way into this?" Because we talked about it on my podcast many times, and he's so humble about telling the story about essentially being plucked out of Virginia to come learn with these two great guys. So look, you can hear my enthusiasm. It's just an amazing story. It never gets old. And I think I should probably be quiet for a second.
No, thanks, Mike. Thank you very much for that. And of course, we've got Jerry's right of response now. So Jerry's here with us. I'd like to introduce you to Jerry Parker, heads up Chesapeake Capital. Jerry's been in the business, as Mike said, right from the Turtle program, and then subsequent to that in 1988, Jerry, you took on Chesapeake as a co-founder, and Chesapeake has had a marvellous track record, a stunning example of classic trend following. He is our mentor, our guidance, and Jerry now has come out of his shell. And in the last few years, he's now become quite a big social media flirt. And you'll see him a lot on the social media now, on all of these podcasts. But here we have Jerry. And Jerry, you're right to respond to Mike. And then I might get Mike to come back to try and extract some new information that you might not have released in public about the Turtle story. So welcome, Jerry. And tell us about the Turtle Trader story for you.
Well, Mike had a lot of good stuff there. I think a lot of that, what he said was pretty accurate. But yeah, I mean, I was really I was working in public accounting, and I wanted to not work in public accounting. So I wanted to do something different, and I started hearing about trend following, and this was 1982, 83. And I thought, I really liked this trend following thing. And I thought it was a really good idea. And I thought that's probably what I wanted to do with my life. But obviously, shouldn't have expected to get such a good break and learn from these two genius guys up there. That's really the big Turtle story, is how smart those guys were. I mean, just you figure 1983, combining real world trading experience, which they both had in the pits trading commodities in Chicago. Math, Bill is probably the smartest math guy that I've ever listened to or known, certainly as relates to trading and investing, and computers. And in 1983, merging all of that together, it wasn't some accident that they picked up on trend following. And really, I mean, it's just so much to say, but I think one of the things that from day one in December 1983 was, we're going to teach you guys these eternal lessons. This is not something that is going to be good for the next year or two. Things are going to change, markets change, people change, but we're going to give you the tools to be successful for a long, long time. You'll have to evolve and come up with better ideas, new ideas as things change. And so that is exactly what I've done. And my wife is like laughing over there about everybody saying how humble I am, because I'm not very humble. But I will say that, number one, I could have been a lot more successful, for sure. And number two is, if you want to, from the lesson in 30, this is like my, coming up on 40 years, 1983. is that the big lesson for me was, oh yeah, I was the most successful, maybe, whatever, however you want to decide that, but whoever was going to be the most successful was going to be the one who followed the rules the best. And it's so difficult to do. And if I'm number one, or if I'm successful, it's only to the degree that I follow these rules, these principles that they taught. And that is so hard for human beings to do. And can trading be taught? I could teach everyone in here how to trade. It's just, are you going to stick with it? Are you going to believe it during the hard times? Are you going to not interject your own wrong ideas, bad ideas? And so that's definitely been the lesson for me, is that when I got off track, I knew why. It was like I was veering too far away from what I'd been taught. And so yeah, it was a great experiment, great, lucky, obviously luckiest thing ever. I read an ad in the Wall Street Journal, and I was like, about being hired, and I sent my resume in, and I mean, who would have thought what would have happened?
There's the ad.
Yeah, there it is.
Mike, I don't think we should let Jerry get away scot-free out of this. Now, what do you want to drill him with?
I want to ask him about the secrecy part of the whole thing, because here we are all these years later, and it was a relatively large group. And I know Rich Dennis has appeared on the one podcast, the Top Traders Unplugged. But overall, Jerry, you seem to be flying alone, where in the sense that you're out there, you kind of must have made some internal decision about being more open and being more public, because nobody else really, back in the day, there were some interviews with people here and there, and maybe some other turtles were featured in Futures magazine, but you've really embraced, as Rich said, the social media flirt, but you've really embraced this. Was there ever any conflict for you to do that, for you to be so open when it doesn't seem like anybody else in the whole experiment really is at your level of openness?
Well, I think what we do is based on principles and not so much on specifics. And I think when people were not willing to talk to you early on, it was probably because of some loyalty to Rich. And I don't know if Rich would approve of such a thing. And I don't think that the people you were probably wanting to talk to trusted themselves to get on these, to talk to you and not say too much. And but the only thing worth saying is just broad principles and philosophies, not necessarily any specifics, because that could change over time, and it's not that interesting, and there's no reason. People could love trend following, they could love hearing the stories and hear what I have to say or anybody has to say. They're not going to be too uptight if we don't tell them exactly to the decimal place where we get in and where we get out. They don't really expect that, so it's sort of unnecessary. I think would have been much better if we would have been a little bit more secretive, but a little bit more forthcoming on the principles and what makes trend following work, the diversification, the systematic approach, the rules, price only, don't pay attention to the fundamentals. Although I would say that I am very interested in all these fundamentals. I like to know what's going on. I like reading, and I like economics and politics and stuff. And I think all that stuff is fascinating. And I wouldn't say get rid of that, but just don't use it in your trading. You don't want to use that stuff. The money part is just too important. You don't want to mess with your trading with all these stupid fundamentals, because it insinuates that you can predict and that the world is sort of logical, which I guess sometimes, or at the end of the day, it might be somewhat logical, but not that it's going to be better than just following the price of something and not using your emotions or any sort of predictive ideas that you might have. And this is just proven over and over again, the inability for humans to sort of predict things. What's going to happen and how far it's going to go, it's totally impossible. Nobody can do that very well.
Well, I'm just happy that you made the decision to be a social media influencer.
And I would say that another thing I didn't want to leave this out. Rich is on a lot of my social media stuff, and so is Moritz. And I think they would totally agree that 90% of the people who listen to us talk disagree with what we say. And so we're always getting people who just cannot understand why we have these views. They're so against. So this is another thing. Can trading be taught? Yeah, I can teach you how to trade. You're not going to agree with it, And I think when Rich said he could print the rules on the front page of the New York Times and nobody would follow it, I think at that time it kind of meant people wouldn't be able to be disciplined enough to follow it. You're supposed to do this. This is one. Here's like 10 rules, and people are like, I can't do this. I can't hold on to this profit this long. You're asking me to hold on too long. I don't want to take all these small losses. But I think today it means, I'll have 20-year-olds come up to me all the time and say, no, you're wrong. I'm like, really? Yeah, you're wrong. So now in this day and age, in 2023, it means anybody would just disagree. They don't really know too much about anything. Like me, I didn't know anything. But I knew I didn't know anything. And so when we got there in 1983, then there was 12 people. Then the next year there was 8 for a total of 20. We were handpicked primarily because we wouldn't get in the way. We knew we didn't know anything about trading, and so we were just open books, willing to absorb what we were taught. And now that's really hard to find that these days. We get a lot of people disagreeing and arguing with us on what's right about trading. So I can talk about a lot of things. No one really agrees too much.
Well, I think, Jerry, Mike, you've earned a bit of a rest now. You can relax for a bit before we get into the panel discussion. But now I'd like to just focus on what we're calling the emerging turtles, these little hatchlings that are now coming out. So we've got our Bavarian turtles, which is Moritz Seibert and Moritz Heiden here from Germany coming to speak with us today. And of course, we've got Adam and myself. We're the emerging turtles over here in Australia. And we'll be talking to you as well. But we'll start with Takahi. So, gentlemen, what attracted you to trend following?
You mean me?
Either one. Which one?
First of all, good evening, everybody. It's great to be here. Thanks for coming along. It's really fun. I used to live here. It's always great to be back. It's a quarter of a century ago. Also, some old friends there in the corner. Great of you to come by. So what got me to trend following? It's actually a long journey, but after a while you figure out it's really the only thing that works in a resilient and robust way. And I've tried many things, like mean reversion trading and this, that, and the other thing. You put a human being in front of a Bloomberg terminal and give that human being a bunch of data. Miracles happen. You always find stuff in the data, right? You always find things that work in the past. But then when you actually set it live, it's not that robust, it's not that resilient, it does have left-tailed exposure, it lets you down. And I just came to, also like knowing Jerry for a long time now, these principles, these trading rules that keep losses small and let the winners take care of themselves over and over and over again on a diversified portfolio, it is actually the most protective strategy that I could find, and it continues to work. But it's not easy to follow, that is the thing. Jerry has just mentioned that. It takes you down path where you think, I shouldn't be holding that position as a human being. That trade has gone too far. You look at this orange juice or cocoa trade, it just keeps going higher. And I think we excel at keeping these positions way beyond the point where most, human discretionary traders would feel comfortable holding them. And that is where the big money is eventually made. That is also then very protective because it's by definition a positive outlier trade, a positive excursion into the right tail of the distribution as opposed to the left tail where the losses are very large. We like these big size winners. You get that with trend following. So that's, over time, you just migrate to that. You think about it a lot, and then that just becomes home. At least this is how it was for me. I'm not sure about you.
Oh, I just followed you.
You followed, so.
Wise move, Moritz.
There you go.
All right, well, thanks very much, gentlemen, from Takahi. So, Adam, the same question to you. Adam's with East Coast Capital Management, as I am. What got you into trend following?
Well, I did my tour of duty in the investment banking scene, and I have to say I didn't particularly enjoy it on the sell side, and that I moved to a hedge fund in Sydney, and they were long volatility, global macro traders, and that's where my interest in systematic trading began. And I have to say, actually, it's Michael Covel's book, Trend Following.
There you go, Mike. Can you hear that?
Making millions in up and down markets, that really got me into the trend following space, and in particular the program manager descriptions, and then also the track records in the appendices, where Michael puts the month by month returns in the appendix, and you can just see the track records over 20, 30 years, and you can see that the strategy is robust and it works. And that was my aha moment, as Michael would say, that got me into trend following, and I've been there ever since.
Excellent, Adam. All right, gentlemen, now we're all back. Mike, Jerry, guys, we're back. We're now going to have this panel discussion where I'm going to ask some furious questions to you all, and you're going to respond in a very brief, succinct manner, so that we can keep this to within, say, 2 weeks presentation time. So I'm going to start with Moritz's, the two M's, the two quants, the two M's, the M&M's. Okay, what do we mean when we say we are systematic trend followers? Gentlemen.
We use rules, principles, systems to figure out whether we should be long or short. That's it. There's no second guessing. There's no fundamental analysis. None of that stuff really matters. As far as we're concerned, we're using a daily bar. That's an open, a high, a low, and a close. That is really all we need to form a trading decision. And we keep on doing it over and over and over again. We bet essentially the same amount of risk on every trade that we take. We appropriately size it, and then just do it on 90 markets in our case, which is really diversifying. That's it. It's systematized.
Yep. All right, Moritz, anything to add, or just what he said?
Yeah, just what he said.
Actually, what maybe you should say is, I didn't know, he's the clever Moritz with the PhD. I didn't know that we actually did have turtles in Bavaria. I thought we were kind of like full of beer and lederhosen and stuff, but according to Moritz and Oktoberfest, but there is apparently land-based land turtles.
So we went out last night and they asked, what's the dress code? And we said, lederhosen is verboten. So, Jerry, over to you. Your programs have had over a 35-year or so track record. Congratulations, by the way. So you have navigated the dot-com collapse of 2002, 2003, the GFC in 2008, 2009, the COVID pandemic, the recent bond rout. So what makes trend following such a robust principle?
Wow. Well, I think we make most of our money on per year, maybe like 10% of the trades. So it's just the big trades that make all the money. It's just a few trades out of hundreds that we do, and just using. And then we have a tendency to make money on things that have never happened before. So you need to design your strategy to where you can do that. And so these strategies can't be very complicated. They can't be very opinionated. They're just looking for some strength or weakness in the market, strength to get long, weakness to get short, and then you don't miss anything. You never miss the big trades. But the problem is you get a lot of bad trades. There's not a question, we're never going to miss one. I mean, something can happen and certain things can crash, and it doesn't work out like it does almost all the other times, where you have plenty of time to turn it around and get in gear with the trend and get the right position on. But really, we have these rules, but they're not that great. And so they're not that specific. And that's how you pick up the big trends, that's how you make the money, and that's why also you have 60% losing trades. And most of the trades don't do anything, and they're small losers or small winners. So it's a very frustrating way to trade. It's a very humbling way, and it's a way that big profits turn into losers and big profits turn into small profits. And it's very disappointing on a trade-by-trade basis sometimes. And you're just always telling yourself that the data says, keep doing it, because over a long period of time, you'll make money. Is that good enough? But for most of the time, I don't really feel like it's that great. It's like, I have this trade on like cattle, and it just crashed. And I'm like, oh, it looks so embarrassing, to follow those rules. But when you add all the trades together, then it looks really good at the end of the year. You get this big bank account. So that's what you're looking for. I lost my train of thought. I got too much to say.
No worries, Jerry. I'm going to get Adam to take on some hard yards now.
Just FYI, this is non-alcoholic beer. So.
Well, that's what he says. But anyway, Adam, over to you. Why do you think diversification is so important for trend following?
Well, so firstly, diversification is the only free lunch, and you can diversify across managers, you can diversify across systems, you can diversify across time frames, and also markets. And you've got these major asset classes, equity indices, bonds, commodities, and foreign exchange. And within those asset classes, you've got the individual instruments, and we trade something like 60 futures. And everybody here is doing something a little bit different, but overlaying these trend following models over those asset classes and those individual futures instruments, in our case, is what allows us to catch the outliers, like the orange juice, like the cocoa, long dollar yen, et cetera, and 2023 has been a great year for trend and for outliers.
Thanks, Adam. So over to the M&Ms. How many markets do you trade, and how do you decide to include new markets into your diversified portfolio?
So we trade in 90 markets at the moment, and we are expanding that universe all the time, basically looking at new markets. But it always has to make sense, right? The market have to be tradable, accessible for us. They have to be relatively liquid so we can actually trade them. And when we look at them, we definitely try to look for markets which are uncorrelated to existing ones. So the idea is always like, what's the additional benefit of adding the 10th energy market, for example, in oil? Rather look at something that is uncorrelated, that really gives you an edge, because what you want to have is independent return streams, independent price series in the end. That's what we do. We look at the universe, and sometimes there's like stuff you haven't heard about, sometimes there's stuff that like even we haven't heard about and that pops up on our radar screen. So like I like to give the example of one of the biggest commodity futures in China, which is Chinese yuyube. So probably without a Chinese wife I wouldn't know what yuyube is, but
Yes.
it's a plum.
Thank you. Yeah.
Stuff like that. So
Yeah.
things pop up.
Yeah. Excellent. Thanks very much, mate. So Jerry, over to you now. So the question to you is, trend following traditionally has focused on futures markets. Now Jerry has decided to change that ball game totally and now heavily trades trend following within equities. So Jerry, why the focus on equities, and what are the benefits you're getting from it?
Well, I think to maximize the the success of trend following, you need to trade more and more markets. So all these guys trading 60 and 90, they're on their way to hundreds and hundreds probably, like I was, like I am now. So trading a lot of markets with a system that doesn't focus on smoothing out the returns, smooths out the returns. So that's what we want to do. We're not in favor of not smoothing out the returns. We're just not in favor of doing too much optimizing. And so the way I get around that is I trade more and more markets, and they're somewhat independent. Sometimes they're not that independent. Whatever you can dream up, any bad thing you can dream up in the markets, it's going to happen. Everything you have on is going to be correlated. Currencies, commodities, stocks, bonds. You're just going to have the wrong positions on sometimes. There's nothing you can do about it except get out of those positions quickly and preserve your capital. But with stocks, this is an easy and obvious way to expand the portfolio. We have a tendency to focus on a lot of commodity companies and stocks, miners. We trade Aussie companies, Canadian companies, US, Europe. There's some commodities that are not accessible by futures, uranium, lithium, marijuana, other types of commodities, steel. And then sometimes you may get into gold and silver and mining, or food products, grains, and you'll have a trend in the commodity, the soybeans or the corn, and you'll have a trend in a company that's involved in that. Sometimes the trend in the company will be better than the commodity. Sometimes it won't be. And so, and there's so many stocks to choose from that if you do, you can do a pretty exhaustive search and do a decent job of finding these stocks that do give you lots of diversification. There's thousands of them. If there was 1,000 commodities, commodities would be half the portfolio. If there was 1,000 currencies, but there's not. There's 1,000 stocks, and that's why I make it about half the portfolio, because it deserves to be half, strictly because it adds that extra layer of diversification.
Thanks, Jerry. Okay, so Adam, over to you. So what measures do you prefer in assessing performance of trend followers, and what do you mean by risk-adjusted performance?
Yeah, so the goal, I think with all of us is to maximise the absolute returns and deliver, positive and sizable absolute returns. And we're doing that whilst maximising those returns and trying to minimise the risk that we're taking. And so whilst, return calculations are not really controversial when it comes to risk, there are differing views, and, people have volatility. We also have drawdown in, magnitude and time. And then also ultimately this concept of a permanent impairment of capital, which is obviously what we're all seeking to avoid as trend followers, and protecting our capital and growing it over time. So that's at the portfolio level. And then at the trade level, when we talk about risk and return, we're really looking to let the profits run whilst cutting the losses short, and that effectively creates an asymmetric return profile where we capture the upside from trends like those shown on the screen, whilst ruthlessly cutting the non-performing trades.
Thanks, Adam. Well, noticeably, trend followers typically focus across a broad array of different asset classes, in fixed income, in commodities, in equities, and in forex. But for the M&Ms, I want to ask you this question. Talk about some of these alternative markets that are not typically addressed by the trend following community, and are you attracted to those alternative markets?
Yeah. Well, I am. We are. I don't actually like to call them alternative markets. To me or to us, they're just markets. Not everybody trades them, but they are available. It depends on your size and your AUM and the liquidity of these markets. But think about sunflower seeds and white maize and oats and canola, and you have orange juice there on the chart. There's freight, there's power, there's all the emission futures all over the world. There's New Zealand power. These markets are accessible. Sometimes there's extra legwork required to get to them, specialist broker relationships. It is a question of time and AUM that you have, right? It's when you're relatively small, you probably don't want to be trading too many power markets. They're relatively large and you wouldn't be trading that much. But as you grow, mathematically, there is a benefit, a diversification benefit that is to be had essentially for free by adding a new market. And that's the beauty of using computers and systems. The system does it for us. It really, the compute time is probably 1 microsecond more for another market. Who cares? I can trade another market. And if it's freight, Panamax, Supramax, then why not? Because more likely, sometimes they are correlated. These correlation profiles do change, but we all have equity risk or like real estate, and we have fixed income exposure in our portfolios. I think it's really valuable to give investors something that is not already included in their portfolio, that is really moving differently or has at least the chance to move differently when all the other stuff moves together. Like some risk event happens in the world, the S&P 500 reacts to that, the dollar reacts to that, the 10-year note reacts to that. Property markets, maybe you don't see it, but they will likely have reacted to that. But when you're trading, I don't know, glass futures, or you mentioned Jujube, I don't even know what that is, or electricity or power, that is just too independent. It doesn't move with whatever is happening in the world, and therefore it is so value add, really.
Thanks, Moritz. So, gentlemen, and this includes you too, Mike, we're now going to talk about some big outlier trades that we've all loved in the past. Any that have come to mind to any of you that you'd like to describe to the audience here about what is these outlier trades we're talking about for trend following. We've got some charts on the screen. Mike, I don't think you can see them, but you might be able to, with a narrative, just explain some of the big outlier trades you've seen over your career path. And if all of us could perhaps just pick out a couple of examples, or maybe one or so examples to explain that to the audience. I'll start off with, let's start left to right. I'll start with Adam first. Adam, is there any outlier trades you'd like to talk about?
Oh, I think 2023 for me, and I'm only going to pick one so I don't steal everybody's thunder, but that was orange juice for me. And we bought that, I think we were long actually from 2022. So I think that went over 12 months on our system. And I think I did some work on that, and that was a 50 ATR positive excursion for our trading system, which I think is one of the biggest ones that we've had. And it certainly makes up a big contribution to this year's returns.
Thanks, Adam. Okay, to the M&Ms, outlier trade. Give us an example of one you've loved.
There's quite a few that we're still loving. It's not in the past tense because we're still hanging on to them. Let's see what happens. But I mean, you have it on the chart there. Cocoa is absolutely an amazing trend, both in London and in New York, as is orange juice. And I just love that. So we're long. It does have the setback occasionally, like orange juice did probably a week ago or 2 weeks ago. And but look, that doesn't mean that the trend is over. Our exit is far away from that, and maybe it's going to make new highs. Even the bonds, like the last 18 months, we've made a lot of money being essentially short every bond that you could possibly think of across the entire duration curve. In ATR terms, not as junky as OJ, but in money terms, really, really good.
Thanks, guys. Now, Jerry, tell us about an outlier trade that's hit the ball out of the park.
Well, since I'm old guy here, I'll go way back in history. But the first big trade for the Turtles was Feb heating oil, 1984. So we started trading January 1984, and so Feb heating oil, and that's another situation where we trade heating oil, unleaded, crude, natural gas, and so sometimes those markets are highly correlated. But I trade them, and because sometimes they're not. And in that particular year, that was a big move in heating oil because there was, I guess the heating oil had to be brought into New York, and the harbor was kind of frozen. And so crude kind of sat there, the unleaded sat there, but Feb heating oil really took off and like doubled in price. March, no. Jan, no. Just Feb. So not only did you have that one market that was 90% correlated to heating oil and crude, but it was 1 month. So that was pretty good. And then, heating oil again, December 1990. In 1990, I made 30%, and I made 30% in December, and it was all heating oil. And I think that was another frozen harbor thing. And so that's another confirmation of this lesson of where you're sitting around and nothing's happening for months and months, and all of a sudden you have this one big trade or a handful of trades like that heating oil, and yeah, that makes your whole year. That's why it's so important to have this strategy that never misses the trade. Exits are important. Nothing's more important than getting in that trade, and that's another way for you to really screw up is you look at these markets and you lose on a certain trade. All of us have lost on cocoa for like 10 years probably. And not only did we take that cocoa trade, Moritz and I, we trade two cocos, UK, London cocoa and US. So that's our response to getting kicked in the ass, is we want a double portion.
We only trade one cocoa.
Let me, Rich, I know we have 2 weeks for this presentation to conclude. So some recent examples, and Jerry has mentioned that as well, everything kind of happens in markets at some point, like the stuff that nobody can predict, and it's absolutely pointless to predict it or listen to CNBC or anybody else having a forecast on these markets. Grain markets in Europe last year with the Ukraine conflict got massively, massively volatile in all TTF, European gas contracts. Crude oil went negative, the May contract, at minus 32 whatever dollars, right? Yeah. I mean, these things are just, that stuff where you would probably as a human being say, that's not happening, it can't happen, it can't go negative. And yet it does happen. And like Jerry was saying, to get into the trade, to be short crude oil, fully sized, not, oh, we didn't speak about dynamic position sizing and dialing that footprint down, right? So just go with that thing. That is really the beauty of these systems. You know, they then produce these massive returns at a point in time, not guaranteed, but sometimes at a point in time where the rest of your portfolio is really suffering and not making a lot of money. And then you have an opportunity to shine. That's really great.
Mike, I know you're a competitive guy, and they've all told these tall stories about the big one. Can you do a better one than what these guys have said?
So there's a story in a trader that I've attempted. I don't know if this is the right way to say it. Not attempted to make famous, but there's a particular trade that Paul Mulvaney pulled off in October of 2008, and it really surprised me when he gave me the rundown of how he did it. And he was trading weekly bars, and he must have given me this rundown for either the fourth or fifth edition of my trend following book. And he was like, "Look, I was trading weekly bars. I'm short the S&P. I can't remember the particular government announcement, but there's a government announcement in late September, I believe, and it bounced the S&P back up, but it didn't touch his weekly bar. And then wham, bam, thank you, ma'am, October came into play, and he ended up making like 45% for the month, which to me should be in every freaking college textbook. Why did Paul Mulvaney make 45% in October 2008? That should be a freaking class. So anyways, that's my one ad.
No, thanks, Mike. Thanks very much. Okay, back to you, Jerry. We talk about diversification of markets and systems. How much diversification is enough?
Yeah, that's a good question, especially for me, because I just can't stop. I'm addicted to acquiring more and more markets. I treat them like they're my little children, Well, I think something you came up with was this small bet size and how important it is. We love the diversification, the longs and the shorts, and the safety, but sometimes, something really bad happens, and we've seen it a handful of times, and it's having this small bet size. So when I take a full loss with my over 300 markets, when I take a full stop loss, it's not that small either. It's pretty optimal and not too close to the market. I lose about 15 basis points. So just the power of attacking these markets every day and knowing that almost every single time the worst case scenario is 15 basis points. Is really a superpower, and it really helps you have the proper mindset. Like, of course I'm going to do that next trade. Of course I'm going to follow the rules, because it's just really not a lot of money involved initially. But if that thing gets going, 50 ATRs, sometimes 500 ATRs. Eli Lilly, one of the biggest trades ever, still going strong. Tesla, we had Tesla a few years ago. Monster trades, and these things go so far, and you trade small, and you don't, but they can really blow into a lot of profit and really have a really positive impact on the portfolio. So I'm addicted to more and more markets, more and more safety. The accountant in me comes out in that regard.
Yeah, thanks, Jerry. Adam, over to you. So we recognise that trend following is quite a broad church. We are what we call the classic trend followers, but there are these other heretics in the trend following world who do different things. But from your perspective, why is it important to offer a point of differentiation amongst even us classic trend followers in what we do? Why is that important for us to offer individual strengths and competencies where we're not doing exactly the same thing, but we are abiding by the golden rules of classic trend following?
Yeah, so it's not like we got together and decided to have different return streams as some sort of a conspiracy of differentiation. But as Jerry says, and he calls it a superpower, and I think the academics call it time series momentum, and that's effectively trend. And what we're all trying to do is exploit time series momentum and trends. And we've built these systems organically, without talking to each other really in the development phase, and using resources like Michael's book and other resources. And these systems have grown up organically and independently. And even though we are somewhat correlated, effectively we are unique in those return streams.
Excellent. Thanks, Adam. Okay, so back to Jerry. Now, Jerry occasionally does these fantastic statements that become sort of like on the Hall of Fame for trend followers for many, many years. But the latest one he's come up with is the name of his new ETF, TFPN, which means trend following plus nothing, TFPN. So, Jerry, why is it important, this statement of TFPN, trend following plus nothing? Are you suggesting we don't need anything else?
Suggesting? Well, I think, yeah. I mean, I think trend following plus nothing, meaning plus negative skew, long only, stocks and bonds. That's exactly what I'm suggesting. But I also trend following everything. I try to trend follow as many markets, all the markets, as many markets as possible. Yeah, I don't think trend following needs suboptimal strategies added to it to smooth it out. We got to be strong and bold and see the merits in following these rules, doing the right thing, doing the hard thing, understanding that at the same time this strategy does have some volatility because we're letting the profits run in the way that is appropriate. We're also doing the best job of anyone of protecting capital because we're taking these small losses and small bet size. And of course, the best friend of the capital is handling that current open trade profit in the optimal way. So adding in other types of strategies. I remember Rich told us one time, like if you come up with a strategy that doesn't really make money, but it kind of is a complement to the trend following, you should consider using it. And I was just like, no, I can't do it. I tried to do it, but I just couldn't make less money. And I just said, change myself to understand that this volatility in open trades was not a good indication of risk and risk of losing money, losing part of my capital, and improve upon me. And so I would allow myself to trade better, more optimal strategies. So, you know, and like I think one of our reasons is no one is out there trend following stocks like we do. These stocks, they need a stop loss. They need a trailing stop, just like everything else, just like those bonds. Being long bonds in your portfolio last year was like ridiculous. This year, ridiculous. You know, you need to be short those bonds. They're in a downtrend. So, yeah, I've just had way too much success, and I kind of know better that you're not one of these days you're going to be very unhappy with this mentality of long only anything. Everything has its day to be long, and you need to be short as well.
Thanks, Jerry. Mike, over to you. We call ourselves price followers. How does that differ to price predictors?
So I saw this question before you asked me, and I thought to myself, what is a price predictor? I have no idea. It brought up the larger issue, which is labels, definition. But it made me think about what Jerry said earlier, which is young people that want to argue. And so when it comes to definitions, trend following is not as good of a definition as price follower. Price follower is more accurate than trend follower. But, you know, it's about marketing too. And I'm very happy that in either 95 or 96, I registered trendfollowing.com. And hopefully he won't kick me in the butt when I say this, but there does happen to be a man in the room who back in the day asked me if he could purchase that name from me, that domain name. And I smartly said no.
Yeah, I'll unmute because I know. Oh, I'm going to unmute here, Mike. So because I know Jerry wants to respond to that one.
I don't remember doing that, but
I have the email.
oh no. I'm not saying I didn't do it. I just said I don't remember it. But I would say that obviously my bid was too low, and I could have gotten it, I'm sure.
You didn't even give me a bid. You just asked if I was willing. I said no right out the gate.
Guys, we promised we wouldn't fight tonight. All right.
You want a little action, right? A little action.
Yeah, we need it. We need it. All right, over to Adam. Adam, trend following is considered to be an excellent diversifier for a traditional portfolio. So, for instance, portfolios that are heavily invested in equities or the 60-40 portfolio. Can you explain that and why we really need a material allocation to any of those poor people that have decided to go down the wrong path and invest in these traditional portfolios without going down the path of 100% trend following plus nothing? Please describe that.
So 2022 and 2023 have proven that, passive long-only equities and even 60-40 will not protect you under certain scenarios. And, so effectively you need protection in a sense. And, we've done a little bit of work on pushing out the efficient frontier of existing portfolios. So if you're not 100% trend, like we would all be 100% trend. If you are one of these sorry people that is holding on to these legacy positions, we've looked at the numbers, and I think that when you can allocate 30% plus, you push out the efficient frontier, and you make a huge difference to your portfolio in terms of drawdown, improving returns, and actually reducing drawdowns.
Thanks, Adam. So, Jerry, they say that you can't go broke taking profits, and I know you hate that statement. So can you please explain why you hate that statement?
Well, I don't know if I hate it, but that was an early Richard Dennis idea that trying to prove some of these cliches incorrect. And certainly for me, I could definitely go broke taking profits because the whole strategy is dependent upon taking large profits and not cutting the profits short. And so you can definitely get emotional, get out of the trade too quickly, because this is a strategy that is building up a lot of small losses. And at some point, the small losses can become bigger. The 60% losing trades is a major problem. And so you need to handle those winning trades optimally. So, and that means holding on to those trades. So as cowardly as we may be with the losing trades, we'd be very ridiculously bold holding on to trades that are any normal person would say, take a profit, let's get out. But once again, you look at some of the big trades we've been in, they make a lot of money, and we need them to pay for those small losses. And if you don't get them, you're going to go broke taking small profits.
Thanks, Jerry. Now, I know I promised you we wouldn't drone on, and we have already. So we do have some more questions, but we're going to cut this short now. What I'm going to do is I'm going to give you a quick recap of tonight, so then we can get relax and mingle with the guests and have a good chat, and all of the hard yards are done with this panel presentation being over. So we've discussed with you all why the methodology is very robust and has a validated track record over many, many decades, over many, many different regimes, particularly regimes that are uncertain regimes. This is where trend following particularly shines. But one of the things about trend following, when I do my research on the performance of the hedge fund industry, I notice that there are certain hedge funds out there that do well over 5 or 10 years, but it's the survival of the trend followers. You find that over the course of 30, 40, 50 years, things that are really attuned for long-term wealth production, you find that over the course of time, the only ones left standing are the trend followers. And this is because this is an incredibly robust technique in navigating market uncertainty, managing risk, strictly cutting losses short, and also capitalizing on these outlier opportunities that emerge through letting profits run without applying these complex overlays to target volatility or dynamically shift risk about the portfolio. We've got this proven recipe that Jerry learnt in the Turtles experiment. Mike's written about through the Complete Turtle Trader. Please read that book. Please listen to a lot of, read the books of Michael Covel. He is a heavyweight in being able to describe our approach to everybody about us. But also the important thing in this recap is that we embrace principles of diversification, and in our opinion, diversification is never enough. We're achieving a couple of things with diversification. We are achieving a mix of uncorrelated return streams that serves with very large levels of diversification, such as Jerry's got with 300 plus. That naturally does reduce overall portfolio volatility by being aggressively, maximally diversified using small bets across incredibly comprehensive uncorrelated return streams. But also, very importantly, the reason we diversify is our endearing hunt for the outliers. By diversifying widely, wherever these outliers may be, we will be riding them simply because we've got a systematic process, systematic rules-based process, which doesn't require any foresight, any prediction, any guesswork. We've simply got these rules that, when applied in a maximally diversified way, we will be on those trends. It's not a case of if we will be on those trends. If we have invested our trend-following systems in these diversified markets, we will be on those trends. There is no guesswork, there is no prediction, there is no assumption. We're price followers. But finally, we also find that the trend following model, if you have made the mistake, unfortunately, of investing in alternative traditional portfolios such as buy and hold in equities, or you've invested heavily in a 60-40 portfolio, we will provide a bit of a rescue package for you if you materially allocate maybe 30 to 40 to 50% of that failed money into trend following. We will support the traditional portfolio with our proven diversified approach. Just to demonstrate the power of classic trend following, what I've done here is a little example where you'll notice this chart on the screen. So what this chart is doing is it's saying, let's look at an equal allocation, and for the example I'm using here, I've said, all right, we're going to take one of Jerry's programs, the Diversified Plus program. We're going to take one of Moritz's, the 2M's programs called the Systematic Trend program, and we're going to take one of the ECCM programs, which is the ECCM Systematic Trend Fund. What we're going to do is we're going to do an equal allocation into all three funds. We're going to rebalance that on a monthly basis going forward, and this is the result we get, this lovely green line, the Turtles line. This is a collaboration of the people here at this event. This is a performance since 2020, when all of our funds were all operating together. This is a performance compared to the S&P 500, which you see in black, the 60-40 portfolio, which you see in yellow or gold, and the ASX 200 total return index you see in grey. In this chart here, you see how when these traditional portfolios were suffering through this failed, unfortunately, this now failed relationship between the historical relationship between equities and bonds, which is broken down in 2022 going forward, we find the struggling of these alternative traditional portfolios, and yet trend following shines. And certainly from the years 20, 21, 22, 23, trend following is doing incredibly well because it is a process designed to really maximize opportunities during market uncertainty. And I don't know about all of you today, but when I look at the geopolitical tensions around the world, I look at market uncertainty, trying to predict what's happening in this rising inflation environment, what's going to happen with interest rates. All I can see ahead of me is uncertainty in my brain. I don't like to predict, but I do want to take with me a very robust investment model with me that can navigate that uncertainty. No predictions, look mum, no hands. I've got this model here, which I'm applying a systematic rules-based process taught by the turtle traders, a very clever Richard Dennis, Bill Eckhart, taught to Jerry. Jerry's taught us a secret sauce. We're telling you a bit about the secret sauce now. Not everything, because we need our secrets, but that is the story of trend following. I want to thank you all very much for listening to this presentation. Sorry it got a bit long and long-winded, but please now, we'll be mingling with the crowd. Thank you all for coming. We hope to take this concept wider across Australia and worldwide. This is a start. This is the inaugural Aussie Turtles. We stand up.
Thank you.
We brought the turtles here.
Thank you so much.
And Mike, we'd really like to say thanks very much, Mike, for coming all the way from Saigon over here on the video, and Jerry and Lisa for coming all the way from New York. They decided that they'd also incorporate a bit of a holiday, but the primary reason they came here was for this event tonight, and on top of that they decided to do a bit of skating around Australia, Lizard Island, Melbourne, etc. And their journey still continues for a few more days while they're here in Australia, and then I think as traitors they're going over the ditch to New Zealand perhaps to look at something over there. But thanks very much, and thanks very much for the Turtles, guys. Thanks very much, everybody.
Thank you, Rich.
Thanks.